Welcome to our investment analysis presentation comparing Harley-Davidson and Polaris. We will provide a brief overview of the automotive industry and a deep dive into the financials of two companies to determine if we would like to become creditors or shareholders of either. Part 1, business analysis. The global automotive industry is valued at just under $3 trillion US. The US automotive industry is valued at nearly $101 billion, makes up 3% of US GDP, and is growing at a rate of about 7% annually. It is broken into 5 segments. Both of the companies we are evaluating fall into the light vehicles segment. Harley-Davidson was founded in 1903 by William Harley and Arthur Davidson. Corporate headquarters is located in Milwaukee, Wisconsin. Polaris was founded in 1954 by David Johnson and his cousins Edgar and Alan Hattin. Polaris is headquartered in Medina, Minnesota. The chart on the right shows revenue for both companies over the past 5 years. Harley-Davidson is represented in orange and Polaris in blue. Both companies experienced pandemic-related hits to 2020 revenue, though Polaris fared better as Harley-Davidson was experiencing a decline in revenue heading into the pandemic. Both companies experienced recoveries, which we will discuss in more detail later on. Harley is one of the original motorcycle manufacturers. Its first facility outside of the United States was opened in Brazil in the late 1990s, and the first dealership in China opened in 2006. In 2014, the Livewire electric motorcycle prototype was announced. In 2020, after 26 years with the company and a couple of years of disappointing sales, CEO Matt Levatich stepped down and was replaced by Jochen Zeitz. In 2022, the Livewire electric bike brand was spun off. After initially planning to keep a 74% ownership stake, Harley was forced to invest another $100 million into the brand when the initial investors chose to exit. Harley-Davidson now owns 90% of Livewire. Soon after the founding of Polaris in the 1950s, co-founder David Johnson and some co-workers developed a vehicle to use in the winter to access their remote hunting shacks. They called it the Snow Traveler. Though it was not the first snowmobile, it was the first one that became widely sold. Polaris entered the ATV market in the mid-1980s, began producing watercraft in the early 1990s, and motorcycles in the late 1990s. They topped $2 billion in sales, acquired Indian Motorcycles in 2011, and just 6 years later topped $5 billion in sales, becoming a Fortune 500 company. Polaris is currently number 419 on the Fortune 500 list, and Harley-Davidson is number 572. Harley-Davidson faces global competition from British company Triumph, Japanese company Yamaha, Italian company Ducati, and Indian company Royal Enfield brands. Harley-Davidson recently pulled out of India due to low market share due to Royal Enfield's dominance. Polaris's top competitors include Harley-Davidson, Yamaha, which produces motorcycles and marine products, Arctic Cat, which produces snowmobiles and off-road vehicles, and Honda, which produces autos, motorcycles, and power equipment. Both companies have strong dealer communities, high levels of customer satisfaction, customer-focused programs, and high-quality products. Harley-Davidson's success is driven by its strong brand equity as it produces arguably the most recognizable and well-known motorcycles in the world. Recently, it has gone through a restructuring and implemented a new business strategy focusing on its top 50 markets and pulling out of 39 countries that were producing low sales. Polaris makes a wide range of products, some of which are utility vehicles for farms, ranches, and construction sites, and as such, these vehicles are not subject to discretionary spending. The automotive industry was marred by supply chain disruptions throughout the pandemic, and some continued disruption is still expected. Manufacturers need to meet stringent emission standards, prompting more investment in electric. Challenges specific to Harley-Davidson include minimal success outside core products, an aging customer base, declining sales in some markets, and a late entry into electric. Polaris faces challenges with imitation products in emerging markets, changes in consumer buying behavior, a high cost to replace existing experts, and comparatively high inventory. And now I'd like to turn it over to Pooja, who will kick off part 2.
Thanks, Tracy. Part 2, financial analysis. We will start off with Harley-Davidson's financial analysis. Harley-Davidson exceeded analyst expectations by 5.8% in 2022. According to the financial results pulled on October 26, Harley has increased its share price about 12%. Looking forward, Harley expects to grow 4.9% across the next 3 years. This is relatively stable growth as the auto industry is projected to grow 22%. As you can also see from the Q3 results, all changes are on a positive trajectory across revenue, net income, profit margin, earnings per share. Moving on to the business risk for Harley-Davidson. Their risks boil down to 5 key areas, including strategic, compliance, operational, financial, and general. An example of strategic risks include failure to execute long-term business strategies and plans. Some specific risks include meeting governmental laws and regulations that change and create additional costs, supply chain issues, recall and warranty costs, credit defaults, market volatility due to exchange rate fluctuations, and potential legal events. That sums up the business risk for Harley-Davidson. Harley-Davidson's business segment includes motorcycles, financial services, parts and accessories, licensing, and other parts. The 2 largest components of revenue generation comes from motorcycle sales and financial services, which account for 80% of their total revenue. The other 3 segments account for 20% of their revenue. Harley-Davidson's executive compensation can be broken down into 4 components. The first is the executive's base salary, which is their compensation for their role. The second is the short-term incentives, which is to incentivize financial and strategic achievements each year. The last 2 segments include long-term incentives in the form of restricted stock units and performance shares to prioritize long-term growth. The CEO's salary is structured slightly differently, with the majority of their salary being tied to long-term incentives. As you can derive, the long-term executive compensation model focuses on aligning executives with the goals of the shareholders. In summary, from the Q3 earnings call, Harley-Davidson is in a good position. Despite the supply chain challenges, the company had a strong Q3 result. They were able to grow their global business 19%. They are on target with their Hardwire strategic plan and continue to grow their branding. They plan to mitigate the supply chain challenges in Q4 and further into 2023. Their focus for the future will be to increase profits, be strategic about expansion, lead in electric motorcycles, innovate into new product lines beyond bikes, and focus on the customer experience. This sums up Harley-Davidson. Kevin will walk you through Polaris.
Thanks, Pooja. Let's take a look at the financial analysis for Polaris. Polaris showed significant year-over-year revenue growth in the Q3, and net income increased substantially by over 60% to $190.4 million, showing a recovery in business that was fundamentally impacted by the COVID-19 pandemic. In the Q3, they beat analyst EPS expectations by just over 6%, with a reported adjusted EPS of $3.25, and forecasted positive growth for the next quarter with a revised EPS of $3.28. Polaris shares a lot of similarities in business risks with Harley-Davidson. The most significant business risk outlined by Polaris today is the ongoing effect of the COVID-19 pandemic on its supply chain. Increases in the costs associated with raw materials and component parts and disruption in their suppliers' operations could affect Polaris's ability to successfully implement its manufacturing operations expansion initiatives. One major differentiating risk Polaris calls out is the impact of unfavorable weather trends, potentially caused partly by climate change. For example, lack of snowfall during winter may affect snowmobile sales, or significant wildfire activity can limit areas where customers can ride off-road vehicles and ATVs, affecting demand. The majority of Polaris's business is comprised of the off-road segment, which consists of vehicles like ATVs and snowmobiles, and accounts for almost 75% of the company's revenue in Q3. The rest of Polaris's revenue is attributed to sales of vehicles in their on-road and marine segments, including vehicles like motorcycles, jet skis, and powerboats. Despite similar market caps, Polaris's CEO is paid significantly less than Harley-Davidson's in total compensation, almost about half. But the rest of their C-suite is very well compensated, potentially earning twice as much as Harley's other chief officers. According to Polaris, their executive compensation strategy targets the market median for a base salary and above the market median for annual and long-term incentives because they are at risk and tied to aggressive growth plans. Q3 earnings call report was very positive. Polaris announced $2.3 billion in sales and a 32% increase in over 2021 Q3, showing a return to growth from pandemic-related effects. Besides positive financial numbers, one of the major focus areas of the call centered around supply chain recovery and its impact on filling depleted inventory levels at dealerships. They're hoping that a combination of softening in retail demand for Polaris's off-road vehicles with the loosening supply chain constraints will provide conditions for the positive restoration of inventory levels. And now on to Vanita to take us through the financial analysis comparison.
Thanks, Kevin. So we used 10K filings for years 2021, 2020, and 2019 for this section. We decided to include the pre-pandemic year 2019 in our vertical and horizontal compares in order to gain better understanding of the true business performance without the adverse impacts of the pandemic, which impacted most industries globally. Looking at the horizontal analysis here, we can see that the biggest fluxes are in Harley's total assets and liabilities, whereas Polaris's changes were comparatively nominal, which suggests that Polaris had better controls and processes in place to manage the pandemic impacts more successfully. Next slide. Continuing on the horizontal analysis for the income statement now for both companies. On revenue, we can see Harley is flat when compared to 2019, while Polaris shows 21% growth for the same period. Polaris was able to sustain a small growth of 4% during 2020, when most intense negative impacts of the pandemic existed. Harley's revenue, on the other hand, declined 24% in 2021. Cost of sale for both companies are in line with their revenues. Looking at net income, when comparing to 2019, Harley shows improvement by 53%, which is primarily driven by decrease in their financial services provision for credit loss. Now that was about 109 million decrease. The second factor is they decreased their OPEX, primarily SG&A and R&D expenses by 151 million. On the other hand, Polaris's improvement of 53% for the same period is attributable to both a core sales growth of 21% and OPEX controls in 2021. Next slide. Here we look at the assets vertical analysis, which takes each asset line and divides it by its total assets for the same periods for both companies. Both Polaris and Harley show consistent 3-year trends in most categories, except for cash and inventories. Receivables for Harley is higher compared to Polaris, and you will see in the next few slides that Harley's AR turnover in days is 56 versus Polaris is only 11. The vertical analysis for balance sheet here, we can see that the current liabilities and non-current liabilities is almost opposite in Harley and Polaris. And then the APIC is also slightly higher in Polaris versus Harley's. Next slide, please. The negative impacts of the pandemic, you can see very clearly for Harley in 2020, the cost of sale pretty much consumed all of the top line, and the OPEX going down to net income also is 0% in both of these categories. Whereas for Polaris, it was pretty consistent with the pre-pandemic 2019 years. So all in all, it seems like Polaris had a better handle on the supply chain issues that was faced worldwide. Next slide, please. Okay, so this is the key ratios analysis that we did. We started by comparing 3 performance metrics for both of these companies to industry standards. The ones highlighted in yellow stars, return on assets, return on equity, and debt coverage. As you can see, both companies did great when compared to asset and equity returns. Polaris won in these categories. Harley's, you can see debt coverage is below industry standard of 0.36. It was concerning. On the other hand, Polaris's debt coverage ratio, 1.28, outperformed industry standards, which means that they were well positioned to cover its debts. Overall, we analyzed these companies in 4 segments: the ability to effectively manage expenses, the ability to manage the assets, assess their solvencies and leverage management. On average, Harley had stronger ratios in expense control and adequate solvency, whereas Polaris was stronger in high quality asset ratios and effective leverage management. Now I'll turn over to Erica, who'll go over the conclusion.
Thank you, Vanita, for reviewing the analysis of the financial statements and ratios for both companies. Now that we have covered all the core business, strategic plan, historical, and financial aspects of each company, we are now ready to reveal our decisions to either lend or invest. When looking to lend, our team used the 5 C's, which includes character, capital, capacity, collateral, and conditions. Regarding character, Harley-Davidson looked promising as they've worked to pay down debt within the last year and even had better solvency than Polaris. However, in the case of capacity and cash flow, both companies posed similar threats. We were most concerned with both companies having the capacity to pay back any additional loans. So we used 3 ratios: debt to equity, cash flow to debt, and debt coverage for further evaluation. Starting with the debt coverage ratio, Harley scores very low at 0.36, even lower than the automotive industry average of 0.75. Polaris, however, scored well at 1.28. As shown on slide 30, the debt to equity ratio for both companies is rather high, with Harley at 4.39 and Polaris at 3.09. When looking at debt to equity ratio, regardless of the industry, anything higher than 2 can be considered risky. Finally, looking at the cash flow to debt ratio for both companies, Harley and Polaris scored very low at 0.11 and 0.08 respectively. After seeing these numbers, we were very concerned because a healthy ratio between 1 and 2 is an indication that a company can cover its debts. Below 1 can signal some financial struggles to pay down debt within a reasonable amount of time. Based on these outcomes, we decided not to lend to either Harley-Davidson or Polaris. From a lending perspective, Harley and Polaris seemed very risky to us. However, when considering investing, we chose Polaris as the company we would like to invest in. We evaluated each company by using the following criteria: earnings growth, stability, industry, strength, debt, price to earnings, innovation, and dividends. Polaris was more favorable than Harley due to their overall earnings growth of 18% over a 2-year period from 2019 to 2021. Not only did they survive during the pandemic of 2020, but they ultimately came out ahead compared to Harley, who had flat growth over the same time period. When looking at the level of debt for both companies, Polaris had slightly lower debt to equity ratio of 3.09 compared to Harley's 4.39. Polaris also had a higher PE ratio of 13.64 compared to Harley's at 11.20. Over the last 2 years, Polaris also had consistent dividend payout per share when compared to Harley. There were 2 additional factors we considered when making the decision to invest in Polaris. One of the key drivers of the company, as mentioned earlier by Tracy, is that Polaris has a wide-ranging product portfolio. Not only do they offer on-road vehicles, which competes directly with Harley-Davidson, but they also offer off-road vehicles as well as boats in their marine division. In the off-road vehicle division, 60% of the business is in the utility, commercial, defense, and government sectors, which means that their products are not subject to discretionary or recreational spending. The other reason why we want to invest in Polaris has to do with their rider-driven innovation. The Ride Command Plus platform has been rolled out as part of their 2023 model year lineups. This innovative platform uses connected vehicle technology to create a more seamless ownership and riding experience through features like vehicle health monitoring and remote location services. Given their growth and strategic objectives, our team chose to invest approximately $500,000 by purchasing Polaris stock. Based on our ROI analysis, if Polaris continues to meet expectations with at least a dividend payout of $2.56 per share, we can expect a little over 15% return on our investment at the end of the 5 years. Overall, both companies have the potential to do well and accomplish some really great milestones to finish out 2022 and going into 2023. However, we feel Polaris is worth investing in, just not lending to at this time. Thank you for your time.